All right, let's talk about a company that might just be one of the best kept secrets in the FTSE 100, Diploma PLC. Today, we're going to break this business down from the ground up, looking at it through the eyes of an investor to figure out if its stellar track record makes it a smart place to put your money right now.
So how are we going to do that? Well, we're going to run it through a classic 5-step investor's checklist. First, we'll figure out what they actually do. Then we'll look at how they grow. After that, we'll see if the numbers stack up, check for any big red flags, and finally, we'll come to a verdict. Simple as that.
Okay, first up, what does this company actually do? And more importantly, what's their secret sauce? Because on the surface, they're a distributor, which, let's be honest, can sound kind of boring. But trust me, there's more to it that meets the eye.
And this is the absolute key. Diploma isn't just moving boxes from point A to point B. They're a value-add distributor. So yeah, they sell these super specialized, essential parts, things that absolutely cannot fail. But the real magic, the thing you're really paying for, is that value-add wrapper of services they wrap around the product. We're talking technical know-how, custom solutions. That's their game. And the business is split into 3 main buckets. You've got controls, that's the biggest piece of the pie, serving industries like aerospace. Then there's seals for things like heavy machinery. And finally, you have life sciences with its specialized medical gear. This mix is super important because it gives them a ton of resilience.
So you're probably wondering, how on earth do you manage all these different, highly specialized businesses under one roof? Well, if you ask management, they'll point to one thing, what they call their secret sauce. What this actually means is pretty cool. When they buy a company, they don't just swallow it whole and slap the Diploma logo on it. Nope, they let it run itself with its own brand, its own leaders. They let it be. And from an investor's point of view, this is huge. It means they can buy these amazing companies without accidentally breaking the very thing that made them great.
Okay, so we've got this cool decentralized model. But a great model is one thing. As an investor, what you really care about is growth, right? So let's see how this thing actually gets bigger.
And this is where it gets really interesting. Diploma has this awesome dual-engine growth machine. On one hand, you've got the steady hum of organic growth from their existing businesses just doing their thing, but then they bolt on this massive turbocharger, a really smart, disciplined acquisition strategy to bring new, high-quality companies into the fold. And hey, you don't have to take my word for it. Just look at the numbers. The company's reported revenue growth was an impressive 14%. But look at how they got there. A solid 6% came from organic growth, but an even bigger 10% was added from the companies they bought. That's that powerful 1-2 punch in action.
And all of this creates what you might call a virtuous cycle. It's like a perpetual motion machine for making money. Because they're naturally capital light, they just gush cash. And what do they do with all that cash? They go buy more great businesses. And what do those new businesses do? You guessed it, they start gushing cash too, which fuels even more growth and, of course, a steadily rising dividend for shareholders.
Okay, the story sounds fantastic. The strategy is elegant. But you know, talk is cheap. As investors, we need to see the proof in the pudding. So let's dig into the actual numbers. Do they back up this incredible story? And wow, just take a look at this. The picture is crystal clear. Revenue has nearly doubled in 5 years. Their operating margins have climbed steadily, now breaking that amazing 20% barrier. And look at earnings per share growth, strong double digits, year in, year out. This is exactly what a high-quality compounder looks like on paper.
Now there's one number on here I really want you to focus on, that 19.1% return on capital. It's a fancy metric, but all it really means is for every dollar they invest in the business, they're generating over 19 cents of profit each year. That is exceptional. It means they are incredibly good at making money with your money.
And here is the rocket fuel for that whole growth engine: cash. In 2024, they converted over 100% of their accounting profits into cold, hard cash. Think about that. For every pound of profit they reported, they actually generated more than a pound of real cash in the bank. That's the money that funds everything.
All right, I know what you're thinking. This all sounds a little too good to be true. And you're right to be skeptical. Every smart investor knows you have to flip the coin over and look at the risks. So what could actually go wrong here? Well, the company is pretty upfront about it. You've got your usual suspects: a big recession, supply chain chaos, cyber attacks. But if you look closely, a lot of these tie right back to their core strategy of buying and managing all these different businesses. So let's cut to the chase. Out of all of these potential problems, what's the one thing, the single biggest boogeyman, that could derail this incredible success story? It's the M&A. Simple as that. Their greatest strength, this incredible ability to find and buy great companies, is also their Achilles heel. The whole model depends on them getting this right over and over again. One big misstep, say overpaying for a large company, could destroy a ton of value and shatter management's credibility in an instant.
And that leads us right to the final and maybe the most important question for any investor. What's it worth? After everything we've looked at, we have to ask, is it a buy?
Well, this is where things get tricky, because the market is not stupid. It knows how good Diploma is. The stock trades at a price-to-earnings ratio of 38. To put that in perspective, that's more than double the average for a FTSE 100 company. That is a very premium price tag.
And if you line Diploma up against its peers, other really high-quality industrial companies, you see it's right there at the top of the class. There's just no way around it. You are paying top dollar for this business.
So this really frames the central debate. On one side, the bulls will say, look, you get what you pay for. This is a best-in-class company. The premium is justified. But the bears will argue, whoa, hold on. This stock is priced for utter perfection. There's zero margin for error here. If anything goes wrong, this thing could get hit hard.
So where does that leave us? Let's wrap this up. There is no doubt that Diploma is a phenomenal company. Operationally, it is about as close to perfect as you can get. But for an investor today, the question isn't really about the quality of the company. The real question is about the price of the stock. Is a near-perfect business worth a price tag that demands perfection indefinitely? That's the question you have to answer. Thanks for joining me.